Hello everybody, this is Gary Mrozinski once again, and it is time for Chapter 5 of the Macroeconomy Today by Schiller and Gebhardt. In this chapter we'll be talking about how we measure what's going on in the economy. The system is called National Income Accounting, and it measures what we focus on in this chapter, how much is being produced, but it also measures things such as what's going on with prices, what's going on with employment. Really, the next few chapters of this textbook are going to focus on the kinds of things that are measured by national income accounting. So why is it we want to be measuring these things? These are measures of the macroeconomy because we want to know how it's doing. We want to know whether we have economic growth. We want to know whether we should be implementing some sort of economic policy. And this course ends with discussions of the two types of economic policy a government can use, fiscal policy and monetary policy, in order to know whether that's warranted or what type of fiscal policy or monetary policy to implement. You need to be measuring what's going on. Then you'd want to measure it after you've implemented the policy to see whether it's working and how it's working. The most important macroeconomic measure is gross domestic product, and we've mentioned this a few times already in this course, and here's the second time you'll see a definition of it. It's the total dollar value of everything that's produced in the economy. The total dollar value of all final output produced within a nation's borders in a given time period. So let me zero in a couple different parts of this definition. First, we define our economy by our geographic borders. It's geographically based. We want to know what is being produced within our borders, regardless of who owns the factories that are producing there. And you'll learn in a second, we didn't always measure it this way. There's another measure that still exists, gross national product. That's what we used to use. Now we're measuring based on what's going on within our borders. The reason for that is because one of the biggest reasons to measure GDP is so that you can then divide it by the population size to get GDP per capita, because that is a good measure of our standard of living, and then we can compare ourselves to other nations. Well, we're really only interested in what the standard of living is within our borders, so we should define our economy that way, and that's what gross domestic product is doing. The other part of this definition that I have not talked about yet is the total dollar value of final output produced within the borders of the nation. This means we're only measuring the production and sale of final goods and services, which means we're not including the production of intermediate goods directly or even raw materials directly. So you could have a steel plant that produces raw steel that's used to produce other products. You don't include the output of the steel industry, the domestic steel industry, in GDP. You don't include it directly. Why not? Well, because you would be double counting the value of those raw materials, because the value of the raw materials that are produced by the domestic steel industry and sold to the automotive industry, for example, in order to make cars, that shows up in the value of the automobiles. That's part of that value. I'll give you my best favorite example of an intermediate good, Dell Computer Corporation. Dell Computer Corporation, who purchases Intel microprocessor chips. So it's the Intel microprocessor chip that I want to use as my favorite intermediate good. The output of Intel is not included directly in GDP. Why is this? Because they sell their products to other businesses. It's an intermediate good. It's a component part that then becomes part of a computer. So the value of an Intel microprocessor, which might be sold to Dell, I'm just going to make up a price, let's say for $50, it's the most important component, most important part in the computer. If they sell it for $50 to Dell Computer Corporation, the value of that microprocessor chip then is included in the $300, which is the price you pay for the PC workstation in Best Buy. The Dell desktop that you buy in Best Buy for $300 includes the value of that $50 microprocessor chip. If you included the output of Intel Corporation, you would be double counting the value of the materials they produce. And this slide is explaining that. This example demonstrates why it is we don't count the value of raw materials and intermediate goods and add that value to GDP directly. These are the steps that might be involved in the production and sale of a wool coat in our economy. So let's go through this. First, it starts with a sheep rancher who produces raw wool. So the sheep rancher shears the wool off of the sheep and sells, let's say, enough raw wool to a wool processor, enough raw wool for one wool coat. The value of that raw wool is $120, so it's sold to the wool processor for $120. The wool processor then weaves the raw wool into wool fabric, thus adding value to it. So now the product is worth $180. That's the value of enough wool fabric to make one wool coat. The wool processor then sells that wool fabric to a coat manufacturer for $180. The coat manufacturer then adds value to that wool fabric by stitching it into a coat and applying a design and a fashion to it, and now the product is worth $220. So the coat manufacturer then sells it to a wholesaler. The wholesaler shows up at the manufacturing plant and takes possession of this wool coat, buys it for $220, and then they provide their value. What a wholesaler does is distribution, transportation, and logistics. So this coat is now going to be distributed, maybe end up somewhere else in the country. So it's going to be on trucks, it's going to go through maybe one or more warehouses, and then be resold to a retail store. So now that this value has been added to this wool coat, that's $50 of value. That's distribution services. It's sold to the retail store for $270. And this might be, let's say, Macy's department store. Buys the coat at a wholesale price of $270, and then they apply their value. What a retailer does is they provide retail services. What they provide to the customer is they purchase a wide range of products from around the country, maybe around the world, and make it all available under one roof for the customer to come in and be able to choose from amongst. And so they have costs, operating costs, and so they're going to mark up that coat from a wholesale price of $270 to a retail price of $350. So they've added $80 of value to that product. Now, as far as how GDP is affected, we only count the value of final goods and services. The final value of this product is $350. What you don't want to do is add $120 to GDP plus $180 plus $220, etc. You'd be adding $1,140 to GDP. And let's just take the first two steps. If you add $180 of value to GDP, that includes the $120 of value, which represents the value of the raw wool. And $220, which is the coat manufacturer, their total value of the product at that point, includes the $180 of wool fabric. So what you could do, if you wanted to, is total up the value added at each step. So that will be $120 plus $60 plus $40 plus $50 plus $80. You would get $350. But this would be so difficult to do practically. That'd be a very difficult way to measure GDP in our economy. It's so much easier to just measure the value of final goods and services. And so when the final good is sold in the Macy's department store for $350, that is added to GDP. This is trying to make the point why we don't try to count up units of products produced. Well, because the units are so different. You'd have units of pencils and units of automobiles and units of air travel, which is seat miles, and units of, in healthcare, bed days of care for inpatient healthcare, and patient visits or stops for outpatient care, all different units of measure. The only one aggregate measure that could be used is dollars to measure what's being produced. And so it's the value of all of the goods and services that are produced. And we're going to learn in this chapter there's two ways to measure that. But the easiest to understand is, imagine that we were to count up all of the dollars that were spent to purchase all the goods and services that were produced in an economy per unit time, like a year. That's what GDP is. Any other way to add up what's being produced in any other units of measure other than dollars just doesn't work in practice. I mentioned GDP wasn't always used as the primary way of measuring output or what's being produced. Gross national product was used, and it's still used. It's just not the way we measure output anymore. Gross national product is measuring the total output produced by, if it's U.S. GNP, U.S.-owned factors of production, regardless of where they're located. So, for example, if a U.S. manufacturer had a factory in Canada producing, the output of that factory would be included in GNP. It is included in GNP. And you add that to what's being produced within our borders. But then you would have to subtract from what's being produced within our borders any output from a foreign-owned factory that happens in the U.S., like a Honda factory in Ohio or a Toyota factory in Kentucky. That gets deducted from GDP to give you GNP. And, as time passed and more of this kind of foreign direct investment was occurring globally, and as the world more and more embraced global trade, it was just decided by most economies the best way to do it is to measure what's happening within your borders. Because again, what we're concerned with is what is the standard of living in our borders, not what the standard of living is in China or Mexico or Canada, somewhere else where a U.S. company might be producing. And this is explaining, again, the value of GDP as a measure of output instead of GNP. GDP per capita, again, is the best measure that we have of a country's standard of living or quality of life. We talked about this in Chapter 2. It's not a perfect measure, and in my opinion, this textbook really hammers home that point, maybe more than any other textbook that I've seen, sort of talking about the flaws of GDP per capita. But just know that it's the best that we have as a measure of or a reflection of a country's standard of living. And so from this point on, we're going to talk about what is not getting measured in GDP, which shows you the shortcomings of using GDP per capita as a reflection of standard of living. First of all, non-market activities. There is work happening in our economy that doesn't get measured because it's not done on the books. It's done off the books. Anything that's done where people are paid under the table, for example, is not getting measured. How about unpaid production done at home by volunteer workers? And let's talk about this on the next slide. This is really interesting. If you choose to maintain your own lawn and maybe even do fertilizer treatments and lime treatments once a year, pesticides, use of pesticides, and of course just cutting your grass weekly, that's a lot of work. That work is work you're doing. You are actually producing GDP, but it's not being measured because you are using your time to produce work and to produce output. It's a service, but it doesn't get measured. However, if you hired another company like True Green or Grasshopper or a local landscaper to do the same work, it would get measured in GDP. Any other work you choose to do at home instead of hiring someone else is work that is production but is not getting measured yet by GDP. How about childcare? Suppose a young family has a child and they look at the cost of daycare and they think, we really need to be working. We can't sacrifice one of our salaries, so we're going to decide to put our child in daycare, and so you pay for daycare. It's getting measured as GDP. It's part of our GDP. Maybe that same family has a second child, and now with 2 children potentially in daycare, they decide, well, now, we really would like to one of us to be home with the child anyway. Now it's twice the cost, or maybe there's a discount, but still it's a lot more than just with one child. Maybe now we decide one of the spouses is going to stay home with the 2 children and produce childcare services for the family. That does not get measured as part of GDP. However, if they had both of their children in daycare and paid for it, it would get measured as GDP. Here are some statistics that are reported by the IRS. 83% of households are making untaxed or unmeasured underground purchases. So this is when you buy something from someone else and don't pay taxes on it, which of course is what the government would be interested in. Now this next number is remarkable. The estimated unreported income per person in 2000, excluding illegal activities. The average person is performing $4,300 in work, or is being paid $4,300 in work that's done off the books. Think about that. Do you think that sounds high, low? To me, it sounds high. I think what it is, and I'm thinking about myself, I can't think of $4,300 in any time in my life. I played in bands when I was younger. I don't know that we made $4,300, just something we did on weekends. That was unreported income, but the average person every year is doing $4,300 of work that's paid off the books. I think what it is, there are some people, a small number of people, for whom they're earning a lot more than $4,300, and then there are other people that are earning no income that's done off the books, and the average ends up being $4,300. Still, that seems high to me. And you could look at some of these other numbers. So, the government, the IRS, is interested in this because this is lost tax revenue. Again, from the IRS, here's the kind of unreported income that is being earned for different types of work. Lawn maintenance, 90%. So this would be, 90% of all lawn maintenance that's paid for is done off the books. So this would be you hiring your neighbor's teenager to mow your lawn for you, that kind of thing. Domestic help, child care, again, this would be paying someone to babysit for your children. Home repair improvements, and you can see the rest of these. So these are the kinds of things that are done off the books and not being measured. Now in the next segment, we're going to talk about a comparison of real GDP to nominal GDP. And this is because a lot of what we measure in economics, we measure in terms of dollars. And we like to compare these statistics over time. The complicating factor is the value of a dollar changes over time because of inflation. So we need to account for inflation. That's what we do when we compute real values, real GDP, real income, and we're going to address this in our next segment. See you there.